debt is the biggest source of risk. And if you have more debt, it creates more risk. And if you have less debt, it can be less risky, right? So at a very basic level, that's kind of the sliding scale, right? So if you see a deal, if there's two deals, A and B, one has more leverage, one has less leverage, and everything else is equal, then obviously the greater risk is the more levered deal. But there's nuance there as well, because I think people are pretty in tune with this, and they're savvy to understand that short-term debt is naturally riskier than long-term debt. And like you asked earlier, well, could potential distress arise due to the fact that people have looming maturities, right? And that's exactly the issue. We don't want to have situations where we have a maturity coming up at the wrong time, or in the middle of our business plan, or just in a situation where the asset isn't as valuable as we'd want it to be, forcing us to do a refi or a sale at an inopportune time. And so the best way to avoid that is to have longer term debt.